everyone, welcome. We're doing this special show post-market hours. Typically, you don't see us at this time, but what to do? You know, this market and the day-to-day has really been shell-shocking. Many are wondering whether this is the worst that we've seen or is it just the start of it all. The Nifty and the Sensex have had their worst single-day point fall ever in the history. So if you were drawing comparisons with 2008, this is a pretty much different beast altogether. And I'm not even going to get into individual stocks. At one point in time, you thought whether the index is going to hit circuit or not. Fortunately, the worst came in only post 2 p.m. and the circuit limit for that time is 15%, so we got a little saved. But even then, it was just one color and that was only red on the entire screen. And, you know, we were not alone in the carnage today. It was across the globe. Take a look at Asia, look at how the Dow futures are panning out, even as we speak right now. Or for that matter, how Europe as well started off trade with shave-offs of about 6 to 7% apiece across the board. The question, I guess, everyone's wondering is, what next?
Nobody knows.
Yeah.
I mean, anybody who claims that he can tell you where the market will bottom out, I think don't believe that person. Because you are in that situation where compulsions have taken over. You are in that kind of a market where you're selling not because you want to sell, but you have to sell because of technical compulsions, leverage compulsions, and which way the flow of the money and machine-based trading is moving. A big difference between last week and this week is that it is clearly evident that risk in the world has got redefined and volatility has really made a comeback. So I think you cannot it will be very difficult to understand, estimate, dissect, judge or preempt what is coming next. What you can look at is perhaps instances when markets have sold off like this and what has happened a month from there, 2 months from there, 3 months from there. So that's the only thing you can do. This is like an extreme positioning of the market, something, we may not report again in our careers. Yeah. I've reported this in 2008 and trust me, even as a market commentator, it was a tough time to really see an excruciating fall of that magnitude. A bull market has become a bear market and it has only taken 45 days for a 10-year-old bull market, which was defined as the biggest bull market in the economic expansion of US, to become the longest bull market, to become a shocking bear market.
Yeah, and we were also talking with Mark Mobius, and he is, someone, a market veteran who has really seen a lot of the cycles. And despite that, he spoke of how the sheer uncertainty regarding the situation that puts everyone in a very vulnerable position has also taken him by surprise. So definitely everyone has been caught very unawares, and that big question mark which remains, that is it time to bottom fish, is the dramatic fall of the markets really over or not, that all those questions continue to remain unanswered. But let's hear it then from the big market voices as to what their prognosis is, at least of the situation so far. My colleague Varun has all of that data. Let's take it across to him. Varun.
Right, we're going to go over two big market voices today. The first one is Neelkant Mishra from Credit Suisse. He believes that it's not time to bottom fish. So that's a bit alarming. He thinks that there's still some de-rating to come, which is going to present some better opportunities. That being said, the Nifty forward PE has peaked in 2018 and the current PE is 17% below the Jan 20 high. 45% of the top 200 stocks, which are 34% of market cap, now are greater than 30% of their lifetime highs. So he advises you to focus on stocks where the PE has declined and will continue to decline going forward. Apart from this, local factors are also reasons for the fall, so he doesn't attribute all of this to the coronavirus. There's some macroeconomic factors at play as well. Moving forward to Sanjeev Prasad from Kotak, he says that valuations of most parts of the Indian equities are now attractive, so he's a little different. He feels he's finding value with the current prices. The situation is quite fluid for them, so it's still evolving, and he sees that a rebound could be possible in the near term, although he's not flagging that off. He says it makes a strong call, though, for investment cases, and he believes now is the right time to invest at current levels, and also that crude oil being really low will provide the necessary buffer to the equity markets for investors who may be more bullish in these times.
You know, the way I would look at this market is that you need to analyze the market purely based on market behavior, levels and valuations. Levels will not hold true in this kind of an epic fall, because the force of selling is so intense that a little bit of buying is not going to make it recover. You have to look at market behavior, which is ET now Greed and Fear Index, our proprietary indicator, Global VIX, which is volatility and indicator of where things are moved, and then you go to look at valuations. I will keep valuations aside because when a reboot button has been pressed on global growth, you don't know where global growth will guess. So two things you don't want to do in this market is guess the right valuation and guess the flow stroke the level. But what you can do is that you can look at market behavior. And Kunal, let's do that. Market behavior is often represented in RSI or VIX, right?
Correct.
It's not for the first time markets have seen this kind of a sell-off. It's happened in the past. Historically, when these factors have come together, which is intense selling, high spike in volatility, oversold RSI, what has happened a month from there? What has happened 3 months from there?
Well, on almost all of the instances, if I can probably put all rather than most, I think on all of these instances, the markets have first step is given you a ferocious bounce. And it's not, a U-shaped rally which you've seen. So the first port of call is that after such a deep oversold RSI or a huge spike in volatility index, the first is, or the first level of market move is that there is a V-shaped rally, and those V-shaped rally generally leads to a 2-3 day kind of a cover up to the move. So we've seen almost 1,000 point fall in the Nifty, if I'm not wrong, from 10,400 to 9,600, 500 approximately. So we've seen 1,000 point fall. Even if there's a V-shaped recovery and we cover 50% of it, assumingly, then we're talking of 10,000 levels being achieved as the first level of stability. But again, historical comparisons adding one more indicator to that is how divergent the prices are from the long-term moving averages. So the 200 moving average for the Nifty, if I'm not wrong, is still at around those 11,000 mark, and we are at 15% or 20% below the 200 moving average. So as of now, we keep on going up, on the lower side. This divergence spreads up significantly, and that kind of a huge divergence generally calls for mean reversion. So we don't know which way the index will move. So assumingly, if this divergence spreads to almost a 20% on the Nifty, then I believe that it becomes a very good buying opportunity for anyone who's more contrarian or has been sitting out and waiting for those a good entry points on the indices.
But the intriguing thing is, Nikunj, that you're not even seeing a flight to safety. I mean, you would assume at this point in time, crude, of course, because of the, various geopolitical dynamics, is a good 50% off from its Jan peaks. But even gold, as Kunal was mentioning earlier, and I'm going to come to him as well for a chart check, that's also showing you signs of topping out. That also has been off the highs.
So, that's how typically markets move when there's fear in the world. What happens? Money will rush into dollar index and money will rush into gold. I guess the reason why this time it's not happening is because abundant liquidity is already floating around. B, markets know that this is not a typical, this is not a time when typical monetary policy will work, which is that when economy goes through a slump, what do? Cut out interest rates. I don't think the scope for anyone to cut interest rates is not there. This problem is a very unique problem. It's not a man-made problem. It's a problem which in a sense has happened because of medical factors. When there's a man-made problem like a global crisis, financial crisis, you can always engineer out of it. You can come up with instruments. If there's a liquidity crisis, RBI can open tap.
Yeah, but what do you do in a case of a virus where even the vaccine is not available?
Exactly.
Right
so
now?
You don't know what the outcome is. You don't know what the impact is. And when asset deterioration happens, you want to protect. So money is not even moving into dollar index. It is not even moving into US Treasury. It is simply
getting back to cash.
Exactly. It's a terrible thing to happen in a low yield world. But when you are hit, you don't know where your base is. I think that's what's happened.
Kunal, but you monitor gold as well closely. What is the sentiment with that asset class indicating to you right now?
So, look at it in the last 1.5 years. Gold started to rally. It was one of the few asset classes which showed signs that something is, not moving in sync with the overall market or the equity move. So, from 1,050 or 1,080 where gold bottomed out, I think from there on you almost saw, $400, $500 move on the index, and then people started to take note of that yes, gold is now out of a 3-year consolidation. But if you look at the last 3 weeks of price performance of gold, the 1,700 mark is acting as a huge hurdle for the asset class, and also in terms of some Fibonacci retracements, the rise from or the fall from $1,900 where gold tested I think 2011-12 till 1,050, it's come to exactly 61.8 retracement, and 61.8 technically in normal environment, I think is a very important indicator. So whether it's resistance or supports, and gold is facing those kind of resistances. I wouldn't be surprised that, over the next maybe 6 months or so, you could see gold trimming off another $150 from current levels, coming very close to 1,500 mark, or even sub those levels as well. I think that's the most high place scenario for gold, maybe over the next 6 months to 1 year.
All right, that's the outlook coming in on gold, and clearly a terrible Thursday playing out for the equity markets. We'll dissect it in further detail, tell you how to navigate the massive sell-off. Stay with us after this very short break.
What a day it's turned out to be, not just for us, but global markets, and the rout continues. Europe, as we speak, continues to bleed with cuts of about 6.5% across the board. And if you thought it was any better for us, not quite. That gap down only worsened up until close. The Sensex and the Nifty have seen their biggest drop ever in absolute terms. In fact, this Nifty has slipped below the 9,800 mark for the first time since September 2017. India VIX, the gauge of volatility, the index, has hit its highest level since 2014. Nifty has now officially entered the bear market territory, and it's down a good 20% from the record highs. Arnab Das as well joins in on the line right now. Arnab, hi, afternoon. You know, who would have thought that in 45 days from discussing peaks in the market, we're going to be discussing bear market?
Indeed. I think there have been a number of surprises and shocks that most of us did not expect. Starting with the coronavirus outbreak, going from a Chinese problem to an Asian problem to now a global problem that's being called a pandemic officially, compounded by what looks like a glut in oil as talks have broken down between Russia and OPEC, and Saudi Arabia in particular. So I think we are facing a number of supply and demand shocks. On top of which, there's I think fairly clearly a lot of concern in the markets about the policy responses around much of the world, particularly the Western world and the United States, in particular to these problems. Right. So instead of having what might be otherwise have been hoped for, a well-coordinated international as well as domestically well-coordinated response from countries that are now facing the onslaught of the outbreak, what we're seeing, or at least what the concern is, that we're seeing a response that's maybe lagged, is incomplete, inadequate, and maybe somewhat misdirected, which all sends the signal that things will have to get worse before policy, actions are taken to limit the downside here. I think there's also a kind of underlying issue, which is that the public health policy response here has to be somewhat contractionary, at least, in order to limit the outbreak and sort of move from this phase of so-called, as they say, from containment to delay, right, to stretch out the problem so that the illnesses don't overwhelm health systems and hospitalization capacity in Western Europe and in the United States, right? That's kind of the issue, that we will have to slow down activity in order to slow down the virus. And on top of that, these kinds of policy coordination concerns. Now, I think if we can take a step back and look at this longer term, right, once we pay the cost of this upfront reduction in activity, we should be able to slow the virus quicker than otherwise, and then the problem will plateau and peak and start to fall back, as it has in China and Korea and other countries that have grappled this problem already head on, and as Italy is now starting to do. So in the longer term, the economy will get through this globally and in all the major economies, and the markets will start to come back. But clearly there's a repricing taking place because of these underlying issues and concerns.
So, Arnab, it's often said that markets are right. Are markets telling you something which today we can't look at, about the shape of the economy? Because frankly, in today's connected world, you don't know what the second derivative or the third derivative impact could be. Today, economy is dragging the markets down, but soon markets will start dragging the economy down.
Yes, I mean, I think in general there's a feedback loop between financial conditions and the real economy, and the causation typically goes in both directions. I think in this case, the way we should think about this is that this is, quite a bit different than the global financial crisis or the Eurozone crisis or the Chinese devaluation, right? These were financial shocks that went from financial markets and bank balance sheets and various kinds of financial balance sheets in the real sector into real economic activity. This is starting to happen. It's starting to go the other way, right? That we've had these shocks in aggregate supply and demand. Let's say we had, starting in China, kind of a global supply shock and a regional demand shock. That's now becoming a global supply and demand shock. So it's starting in the real economy and feeding back into the financial sector. So I think at least from central banks, we're starting to get many of the required responses, right? Which is more liquidity, more rate cuts, and I suppose we'll see significantly more increases in liquidity provision to cushion banking systems from payment problems and from liquidity and cash hoarding. If that should start to happen, there's already some indications of that starting to happen. So I think the causation is going the other way around, and central banks are acting to prevent it from becoming too much of a problem and going back into the real economy. But like I said before, there's going to be a period of adjustment here because of the public health policy response to this problem, right? So fiscal policy and monetary policy can cushion this to a certain extent, but it probably can't completely deal with it. So we're going to have an economic reaction for a period of time. The question is how deep and for how long. Now, I think if you step back and you think what happens during a recession, of course, fiscal policy comes into play, monetary policy comes into play. But by definition, in a recession, it does, those macro policies don't fully address the problem. That's why we have a recession. We cushion it with those kinds of policy responses. Now, I think, it's clear that we're going to have recessionary conditions in many countries. We're not yet prepared to make the call that we would have a significantly recessionary type of global outcome.
Sure.
A slowdown for sure.
Right, Arnab. We'll let you go on that note. Appreciate your time. Thanks much for joining in. And it certainly has been a fall from grace for not just our markets, but across the globe. The rout has extended as world indices have bled in a firm bear grip. Let's take it across to Jayesh, who joins in to tell us a little bit more about which markets have bled the most and which sectors have witnessed the biggest rout. Jayesh.
That's right. This has been, in fact, a global carnage because a lot of markets across the globe have slipped into bear market territory. If you compare, their 52-week highs, and have they slipped more than 20% from their 52-week high as well. Notice how some of these indices, or most of these, belong to the Asia-Pacific region, starting off with Australia, Jakarta, as well as the Nikkei, and you have the two Indian indices, Nifty as well as Sensex, which today slipped into their bear market territory, falling more than 20%. The other rest of the world indices like the FTSE 100 and the Dow Jones yesterday, we saw a 20% decline from its lifetime high. And remember, the pace has been rather fast because last month itself, the Dow Jones was at a lifetime high, and today we are looking at a 20% discount. But moving on, let's also have a look at which other indices in terms of India-specific sector indices have cracked. You have the Nifty PSU Bank Index as well as the Metal Index, which are the top two losers in trade. The PSU Bank Index indeed has touched its record low level as well, declining about 42% from its 52-week high. You have Nifty Metal Energy as well as the Auto Index, about 25 to 35% that these indices have lost from their 52-week highs as well. Along with the Nifty Bank, that also slipped into its bear market territory a few days ago. 25% is what we have seen in terms of drawdown from its 52-week high. And you have Realty Infra as well as the Nifty Index to top it off the list that, the indices that have slipped into their bear market territory.
Leave it at that, and that's what's bled the most. In fact, when you talk about index and world indexes at that, it's also to really try and understand what were some of the individual stock reactions that you saw in trade today. And Vivek joins in to highlight exactly that.
Amidst the carnage that we are seeing across most of the indices, what we've actually done is we've actually cherry-picked a few stocks that have taken it on the chin. And when you're talking about some of these stocks have corrected quite significantly from their recent peaks. The first one, of course, is the aviation sector. Within the aviation sector, we've picked out Interglobe Aviation. Company has come out with a profit warning. Company is impacted quite significantly also by the rupee depreciation. And no wonder then the stock is down over 30% from the recent peak. The next on our radar is stocks which are within the film exhibition, film distribution, as well as theaters. I remember a lot of people, a lot of public have actually been actively encouraged to not congregate in public places. And again, this is something that a lot of analysts on the street, a lot of dealers on the street believe will impact the earnings and it will impact the occupancy rates of theaters like PVR and Inox. PVR has taken it on the chin, down over 30%. Watch out for this particular name, Jubilant Foodworks as well. It's a derived impact that you're seeing over here. There's a high possibility that the IPL would get cancelled. Remember, during the season of IPL is when Jubilant Foodworks sees a significant amount of orders coming in, and this is again something that could impact this particular stock quite significantly. A 20% dip from the recent high is what this particular stock has witnessed. Motherson Sumi, the auto ancillary steel has taken quite a bit of a hit. A name like Motherson Sumi is the one that we have chosen. The company has exposure to both US as well as Europe markets. Also, rupee depreciation is something that have been there, and also given the fact that there have been curbs on travel from the USA, something that is also impacting Motherson. This particular stock is down over 50% from the recent high, and also some of the other names like Apollo Tiles, these are the ones that have really taken it on the chin in the last couple of trading sessions. Last, from the IT pack, we've chosen Mindtree. A lot of IT stocks have corrected quite significantly. Mindtree is one particular name. Remember, the company has quite a few significant clients as far as the aviation industry is concerned. They have come out with profit warnings. Mindtree too could get impacted, the earnings could get impacted, and on the back of that, this particular stock too has corrected over 20% from the recent peak.
Thanks, Vivek, for giving us a sum up of some of those stocks that have been impacted. But no doubt today it was carnage all around. But we've also been talking about if the bears are going to continue to take over the Lal Street and the volatility is here to stay. So how should you be investing in these volatile times? The advice from the big market experts is that you should invest systematically rather than looking for the bottom. That's the word coming in from Madhukela. Here's an excerpt of his conversation with Nikunj.
This is not the time to panic and just think of selling, but this is the time to systematically accumulate, provided you have the stomach to digest the volatility, and if you are a long-term investor.
Madhu, I know you are a big foodie, so I will talk in food terminology. If you eat a pizza, you get instant gratification. If you cook a dal makhani, you have to labor it out, but after some time the rewards are beneficial. So do you think this is time to start cooking the dal makhani and not chase the pizza for quick money?
I agree with you, Nikunj. This is a very brilliant analogy. This is not the time for pizza. This is not the time for looking at instant gratification, but it is a time wherein you will, you will have to cook it properly, you will have to digest it properly and eat it over a period of time.
Do you think with this crisis, the leadership in the market will also change? Because this is the point you've been making again and again every time we've met, which is get out of quality. Do you see it happening now finally?
It is very much possible that the new players, specifically deep value stocks, may make comeback in this market. It's very, very possible.
2020, however, will be India's year. That's the word coming in from Prashant Jain from HDFC AMC. He expects India to gain meaningfully from China's loss in the crisis and expand share in manufacturing industry.
It could be India's year, because what does India really need from the outside world? It is lower interest rates and lower oil prices. These are two things what India needs, capital and oil, and both are very cheap. So I don't think the external environment could have been more conducive than this for India. I think India's growth as it comes back will stand out in this slow growth world. I think the government has done a lot by way of giving tax breaks to new manufacturing units, 15% tax break, and a tax holiday for infra investments by sovereign wealth funds. I think India should get reasonably large amounts of capital because India represents a large economy and it's an island of growth in the current environment. And even in the past, you see, whenever there have been challenges outside India, it has led to short-term corrections in the market, but it has not impacted the underlying economic growth. If you invested in India, I think these are good opportunities to invest, and I see no challenges whatsoever in the external environment. In fact, it's a myth and a wrong notion that India needs high GDP, high world GDP growth for its exports to grow. And we can look at what has happened in the IT industry or in the pharmaceutical generics industry. These industries have delivered 10-12% growth for last few years, and when they were smaller they grew at 20, 30, 50, 100% also. Now the world economy has never grown in double digits, but these sectors have been growing in double digits for 20 years now. So that clearly tells you that if you are competitive, a country like India grows, exports grow by market share gains and not due to world economy growing.
All right, let's slip into a short break right here on the show. On the other side, we get you some big market voices further and tell you about the mood as well in the commodity markets. Stay tuned.
Well, thanks for staying with us. Commodity market and the entire selling route continues even in the commodity market. But Bhuvina, if you have to isolate and talk about minus crude, what else is happening in the commodity market? What is the standout trend?
You know, minus crude, it's actually not that bad. In fact, some of these commodities have actually seen a bit of a recovery kick in from the multi-month lows. For example, on Tuesday and Wednesday's trading session, we saw lead prices slump to their lowest since June 2016. Copper prices as well were at a 3-year low, but a bit of a recovery did kick in. Though, mind you, again, LME aluminium was down by about 1.5%, and maybe net by tomorrow's trading session, or rather, let's just say by today's trading session, we may just be minorly in the red for a lot of the LME metals, on the screen for this week. So I suppose for the rest of the markets, it's not been that bad. I suppose what would come as a shocker is the fact that your usual gold, safe havens, that's gold and silver, have not really lived up to their name, because that as well has been in the red. In fact, on the MCX markets, it's the third straight day that gold has actually been in the red, though, mind you, again, very minor losses, nothing very significant to talk about. Silver, however, has declined by more than 1% in the MCX markets. But remember, gold had hit that record high level of almost about 44-45 grand, and since then, it's just been showing these very, very minor signs of losses. Today as well was nothing new. Even Chinese iron ore markets, for that matter, quite a defiant move seen over there. Yes, in the earlier part of today's trading session, they were down by about 2.3%. On account of the entire rout that we saw, Asian markets, American markets, etc. But again, there was a nice recovery that was witnessed intraday, with the Chinese iron ore prices actually ending higher by 0.2%. So they're still at about $96, $97 per ton, which is not bad, because do remember, this entire supply fear bit is kicking in. Inventories are falling at some of the major ports. And plus, you have Brazil as well saying that, look, the dam near the iron ore mine is still a bit shaky. The mine itself is eroding a bit, so that could as well be problematic. But I suppose you have to take into account the big basket of commodities, and that's crude. Biggest rout seen over there, very, very volatile moves. In fact, this week, these last 4 trading sessions have seen a drop of 30%, a recovery of 8%, followed by another drop of 5 and 6%. So this is the sort of volatility we've seen in crude prices. And naturally, when you're going to have the world's largest crude producer try to topple the other 2 large producers, that's shale and Russia, it's unsurprising that something like this could happen. But again, mind you, it's not that Saudi can also continue this pricing war of sorts for very long, because as per the latest report of the IMF, the Saudi government itself, in order to sustain the sort of expenditures it has, will need a break-even at $83. So it's not like they can also continue with this battle of sorts for very long. And, let's see, 18th March is another OPEC meeting, so let's see if something comes out of there.
very much, Mubina, for giving us all of those details. And that's a word on the commodity markets. While today in equities, investor wealth worth over 11 lakh crores was wiped out in today's crash alone. After, of course, that coronavirus was declared as a pandemic. 9,590 is where we closed in on. But expert views have poured in through the day as we've been trying to decode the coronavirus spook on the markets. We spoke with Morgan Stanley's Rhythm Desai, Mark Mobius and ICICI Pru's Nimish Shah, and they've answered some of the key questions about investing in volatile times. How to take cover from the contagion fear, whether or not the high volatility is here to stay, and how to read the value indicators at this point. Let's listen in.
I think the thing that we're all dealing with is what we call in statistical parlance as tail risk. And the problem with tail risk is that one doesn't know exactly the quantum of damage or when the damage will get over. Now, when equities as an asset class deals with these two types of uncertainties, it is not willing to be rational. In fact, the rationality is that it actually does not think that any price is worth buying. So until that uncertainty settles, the market is unlikely to actually behave, as we would call it, quote-unquote, rationally. So I think what we're seeing on the screen is just reflecting the fact that we're dealing with a very uncertain environment where we don't know what could be the extent of downside to growth or the time that we may actually end up suffering.
Does one figure out, Rhythm, the selling is overdone, or the fundamentals will crack more and markets will crack because fundamentals will crack more?
That's obviously the biggest debate right now. So here's how I look at it, Nikunj. You stand back and you look at valuations. And obviously you can't look at P ratios because we don't know where the earnings are going to be. So usually in such situations, I tend to look at price to book. It's a far more stable and a reliable valuation measure. I look at how equity yield compares with bond yield because that also, I think, on a trailing basis, equity yield is a known number and the bond yield is a known number. So we deal with such valuation metrics. And where we are, if this is a run-of-the-mill type of situation like we saw, say, during demonetization or during 2013 when we had the Fed taper tantrum, then valuations are sitting at levels at which if you buy stocks in 6 to 12 months, I think you'll look back and say that was a smart thing to do. The other thing we look at is sentiment. Now, I have a host of sentiment indicators I look at, like value at risk, like implied vols, like realized volatility, like flows, etc. And we all put all of them into a black box and we generate something what we call as our proprietary sentiment indicator. That number, as of this morning, is actually worse than it has ever been in this century. It was worse off only in the 1998 Asian financial crisis. So essentially, we're dealing with the second worst reading on our sentiment indicator since I started it going back all the way 30 years. So both on valuation and sentiments, what stocks are telling me right now is that if you are patient, if you have the courage, if you're willing to sit and watch the short-term mayhem, then it's possible that in a year from now or in 6 months from now, you will look back and say, that was a great time to buy. Now, that doesn't mean that stocks don't fall in the next month. I mean, the likelihood is that they actually fall rather than rise because of the punishment that they have suffered over the past few days. We all know that when there is so much of punishment to stocks, it takes time for a bottom to be formed. Either time or price, both could be bad in the near term. So in the next month, we could be well lower. But I do feel that from where we are, just on the basis of what's happening to sentiment and where valuations are, on a 12-month outlook basis, I think things could actually be quite attractive right now. Now, of course, having said that, as I said at the outset, This is a tail event. It's not an event which is normal, and therefore, there is pertinent risk to fundamentals. And just in case, the virus spreads even more and spreads more vigorously, then obviously, we'll have to reassess. So I think for retail investors, the strategy is continue doing your systematic investment plans, because you will catch this level and it will get averaged out. For traders, I think they're better off using their own judgment rather than me saying anything, because everybody has their own trading strategies.
Well, I think, initially Trump tried to downplay for good reason. He didn't want to have a panic spread. But then he announced that he would do a tax cut. I haven't looked at the news. I don't think he's announced anything in terms of the payroll tax. And I think that was a disappointment to the U.S. market. And as you know, the U.S. market leads everybody nowadays, because with these exchange-traded funds, ETFs, the impact becomes global whenever the U.S. market goes down. So the correlation, at least in the short term, between the Chinese market, the Indian market, all these markets around the world are very close to the U.S. when you have this kind of situation with a panic. So I'm not surprised that this has happened. And I think we're probably going to begin to see bottoming out, because people are going to be realizing that this coronavirus, yes, it will spread around the world, but it will not result in as many deaths as we had with SARS or MERS, in terms of percent, at least.
Mark, last time we spoke, I think you mentioned that people have to have some liquidity in order to get into markets at lower levels. Given that the fall has only intensified, would you now think it's a good time to get in, or would you still advise people to wait on the sidelines since the situation looks uncertain?
No, I think in times like this, particularly when everyone's uncertain, it is a good idea to put some money in. I'm not saying pour everything in, but let's say if you have cash, maybe put 10-20% in now, and then see what happens, and then keep on going, because we're definitely at sort of the peak of the panic, as you can see globally.
You've been a keen India observer and investor as well. In this decline, what are the pockets which are looking ripe to you? Because, it's almost like a mega sale out here. We're down 900 points in the Nifty 50 alone. Financials, utilities have been of interest to you in the past. Are those pockets where you would value hunt?
Yeah, I think now it's interesting to look at the financials, particularly now with the government bailout of Yes Bank. So some of the banks will begin to look better going forward. There'll be, of course, there'll be more announcements of bad loans. There's no question about that. There'll be an increase. But at least you know that some of these institutions are going to survive, and when this is all over, they'll have a good recovery. So we have to look carefully at them, of course, but that looks interesting. But as you know, I'm more favorable towards consumer-type stocks, despite the downturn in sales in the short term, and in infrastructure-related stocks that are making materials for infrastructure spending.
Someone who's seen many cycles in this market, has this turn of events rattled you? Let me just get a reaction from you on what you're making of it.
Well, it always rattles us because we're running funds and our funds are down, so it always rattles us. But at the same time, we take the opportunity. In fact, just yesterday, I purchased more of our own fund in London because I figured, why not? I mean, the price is down dramatically and stocks are down, so probably a good time to pick up some more stocks. But it always rattles you because you don't know where the end is, and the news is always negative and very negative, and therefore you tend to, be influenced by the crowd.
That uncertainty and vulnerability are two of the key factors that's driving a little bit more panic. But Mark, any sort of large stimulus or any sort of major action that you're expecting from central banks in order to somewhat combat the impact of the coronavirus?
Well, yes, the central banks, as you know, have reacted very, very quickly. And I was quite surprised at the degree of reaction that you've seen. And unfortunately, however, lower interest rates really don't solve the problem. What is needed is cash injections into the system. Now, that means either direct flows to people and companies, in terms of loans and even direct payments, or some way of reducing the tax on companies and people. And this is the reason why Trump talked about a payroll tax cut, because that would put money directly into the hands of consumers and give confidence to the market. So I think.
Well, what about the wealth destruction that's taken place today? Pankaj has been digging out that data and calculating all the market cap erosion, and he joins us in with a quick synopsis. Pankaj?
So these are global wealth, people that we're talking about, and let's first start with LVM, or also known as Louis Vuitton. The owner of Louis Vuitton has lost about 27 billion. That's the wealth destruction that they have seen by about 2020. When we talk about the owner of Zara, and when we talk about the wealth destruction over there, it's about 17 odd billion. So that's the number that you have seen over there. That's the wealth lost by there. So this is the first one, owner of LVMH. We'll pull up the next one as well. Here you go. Owner of Zara, 17.2 odd billion in terms of decline. Mukesh Ambani is the third loser, or 15 billion when you talk about the actual amount, and this does not include today's data. But of course, even Spain markets will open, other markets will open, so even the other data would keep changing. Mark Zuckerberg of Facebook has lost about 13 odd billion in terms of the entire number. Warren Buffett has lost about 12 odd billion, needs no introduction to our viewers. And Julia Fresh Coach and family have lost about 10 odd billion. So that's the number you're looking at. These are the top 5 wealth destructor. The key takeaway, of course, is that Mukesh Ambani has lost 15 billion in terms of his wealth.
That's no small change. Talking about billions of dollars in terms of wealth erosion for some of the big billionaires. But as we wind it down, let's also hear out an exclusive interaction from Nimish Shah, MD and CEO of ICICI Pru AMC, who believes that it's the best or perfect time to buy on dips. However, he has advised that investors need to keep a time horizon of at least the next 3 years to make good use of this opportunity.
We have been consistent in what we have been saying. Damage has happened. Valuations have become cheaper. So we are 20% down from where we were 1 week back. Right, so with 20% correction, what looked good or what looked average at 12,000 of index, at 10,000 of index, it looks better, right? And one has to now decide whether one is investing for 6 months or one is investing for 3 years. And when you say that you're investing for 3 years, this might create, whenever there has been a crisis, one has to take a call whether India survives a crisis or not. If India survives a crisis, I know there can be many problems in the next 1 month, 2 months, 3 months. But if you have got a view that this is a thing that will last for 3 months or 6 months or 9 months, the virus itself and the impact of that virus, overall on a 3-year time frame, if you're buying a relatively cheaper index level, you tend to make money. Look at where the average PE ratios are. Right? Even if you look at the broader PE ratios of a 2021, and we say that it is at 16, but within that 16, there are 2 parts of the market. There are 10 stocks which are expensive. There are 40 stocks which are very cheap. Based on 2021 earnings, it looks like they are available at a 12 or a 13 or a 14. Suppose the analysts are majorly wrong. They are not available at 12. They are available at 15. Then also it is a good valuation to enter. The fear is high, and we have always said when the fear is high, when the news flow is negative, one has invested in India, sentiments are bad. Whenever that is true and the flows are negative, already the FII flows are negative, right? FII have sold in February, FII have sold in January, FIIs are sold in the first week of March, and till now the Indian flows have held on, right? So till last week, I'm talking about till yesterday.
As for the last AMFI data.
I'm talking about even yesterday.
Your funds.
Overall, we get a sense of what is happening in the market. Till now, the Indian flows are positive. Even if the Indian flows become negative and the market gets corrected further, I don't know what is going to happen in the next 3 days, 5 days, 10 days. But even if the market gets to correct further, if you're buying at the valuation levels that are there today, I think one will have a good experience with 3 years in mind.
Every time a reboot has happened, when TMT crash happened, infra made a comeback. When infra corrected, you had a comeback in consumers. When the taper tantrum started, small cap stocks, 2014, I mean, a great interview, I always recall you said, buy small cap stocks. Where will you thumb the table and say, buy this stock, buy this category, or buy this asset? Come the table and tell me.
We have started a thematic a fund of funds which we decide which ideas we'll invest in amongst our stock. So what has that thematic fund invested in? That thematic fund has invested in infrastructure.
Okay.
Right? It has invested in opportunities fund. Right?
Special situation.
Special situation. This is the time to buy ICICI Prudential. I'll thump the table and say that this is the time to buy. If you want to do allocation to equity, this is the time to buy ICICI Prudential Special Opportunities Fund.
Okay.
Right? Because there are problems right now that we face, right? My business will face challenges, your business will face challenges, but our businesses, both your business and my business, are going to survive because we are adding value to the country. So is it a temporary problem or a permanent problem? So will I invest in infrastructure companies today? Yes, I will. Will I invest in metal stocks today? I will invest in metal stocks today. Will I invest in pharma stocks today? All these sectors have not done well in the last 3 years. Will I invest in those 3 sectors today? I will invest in those sectors.
Will you stay invested in telecom, which has worked like a charm for you, or telecom the money has been made?
Telecom, we are remaining invested in. There are only 2 good companies. We had taken a big call in one of the companies.
I've been told that you've got $1 billion plus holding in telecom now.
That is our highest holding. Our highest holding is in one of the telecom companies, and we remain invested because we believe that the good times of telecom industry have just started. I can see your studio around. Most of the people right now are using data in your studio itself. Right? So India is not paying so much. Today all of us are buying data very, very cheap. We are used to free. From free to, we were being charged 100 rupees. On an average, Indian telecom user was paying only 100 rupees. £1. People in West fall off their chair when they realize that we pay only £1 for unlimited data in a month. Right? It is too cheap. Right? We have to pay more for data. And when we pay more, the telecom companies will make much more money than we are making today. I still believe that telecom companies in India are cheap. When competition reduces from 13 players, you have reached 3 players, right? And so I believe it's a fantastic time to invest in telecom companies.